Are we saying at this point that any rally in bonds is not going to give any extra juice to stocks in the foreseeable future because there only will be a rally on weaker data?
Yeah, unless you're able to thread that needle. So like what we've said is the Uber bull case, right, is soft landing plus insurance cuts. So if you're able to kind of soft land the economy, keep payrolls, let's say in the 100 to 150K range, and you get a couple cuts on the side of that, I think that's very, very bullish. My view, though, would be as payrolls are decelerating to that level, the market's going to get spooked anyway, right? Because as payrolls slow, you have to increase the odds that they kind of overshoot to the downside. So, look, I think there's a very narrow window in which lower yields can help you, and that is an insurance cut kind of scenario.
It sounds like you're more bearish than you have been in a while. Is that true?
I would say the risk-reward feels probably as bad as it has, I would say, in the last 12 months or so, give or take. If you look back, the last 12 to 18 months, I think there's 3 times that we were kind of recommending hedging and kind of being careful. One is SVB. We can kind of throw that away. But in August, you had claims kind of tick up. In October, you had payrolls get revised down to 105, right? So we've had data that kind of looked like this episodically in the last 12 months. I think the difference right now is the weakness feels a little broader, and the economic surprise has been quite negative. So you're kind of missing consensus in a more broad-based fashion. Plus, you have S&P at all-time highs, right? So that kind of combination, does make me a little bit uncomfortable. Our base case is still positive, but we're kind of looking over our shoulder a little bit.